So I want to concentrate largely on the housing market. Obviously you can't divorce that from the economy anyway. And I'll finish up talking a little bit about the Irish banking system, because it's one of the factors that obviously also influence housing. So let's start off. I suppose one of the things that always strikes me a bit about some of the media commentary on Ireland in general, I suppose, and the economy in particular, is that a lot of what happens here is not unique. Some things are, but a lot of things are common across other developed economies across Europe, UK or the US. And one of the things that does tend to move in cycles that are fairly correlated is the international property markets. And so we've had this very strong, let's call it a boom, since for the past maybe even 10 years. A long, significant increase in real house prices. And it's been quite noticeable across, as I said, most of Western economies. So on this chart I've got the change in house prices, annual change in house prices in the United States, the UK and the Eurozone. And the Eurozone, Eurostat publishes quarterly figures, so it's just up to the final quarter of last year at the moment. But as you can see visually, it's quite similar. We've had very strong house price growth for some time, I think driven by the same kind of things. We've had obviously very low interest rates in the United States, UK, Eurozone. We've had pretty reasonable growth, but also very strong employment growth in most countries. And of course we had very, very low interest rates, very, very low inflation, which meant that real incomes were growing very strongly as well. Then all combined to give as I said, this long period of house price appreciation. And even in some countries that wouldn't normally see that, Germany, for example, about half of the German households live in rental accommodation. So in the past they wouldn't really have had quite a noticeable kind of house price inflation, but they did as well. And what's noticeable now, of course, is that all of them are seeing quite significant slowdowns. So the Eurozone figure, the annual figure has just dropped to about 3.5%, but in fact in Germany house prices are actually falling now year over year by 2 or 3%, and they've fallen by 5 or 6% just in the last 6 months. And also the United States, huge house price boom there, and that's slowed down, as you can see, very sharply, and also in the United Kingdom. So initially, for the annual change to slow down, you don't need house prices to fall. So if a year ago they were going at 2% a month, and now they're going at 1% a month, obviously the annual change slows. But in a lot of cases now, we're actually seeing some minor monthly falls, and that was certainly the case in the UK. So the reasons are, I think, pretty. The reasons also, I think, are common. If we go back to that one, and that is, of course, we've had much higher inflation, which has dampened real incomes, and secondly, of course, we've had much higher interest rates. So those common factors are at work. And then if we look at our own market, we can see that it's quite similar. The blue line there is residential prices, so so this is the CSO's index. And you can see that actually people kind of forget now, but the house prices did slow quite sharply during COVID. Some people were thinking they would drop significantly, but they didn't, and one of the main reasons they didn't was that the government stepped in with massive support for household incomes. So we didn't get a big rise in unemployment, and consequently house price inflation did slow but didn't fall off a cliff or anything. Rents did slow sharply. I think in particular in Dublin there was an exodus from the multinationals, the Googles, Meta, Microsoft and so forth. A lot of their staff left Dublin temporarily and went to live elsewhere, back to where they came from, or went to a Greek island or somewhere. And as you can see, that had a big effect on rents, but everything recovered post-COVID, and get very strong house price inflation nationally, up 15% at the peak last year. You can see it has slowed quite a lot, and is now down to 3.6 or 3.9 was the March figure. Rents are also slow, but they're obviously holding up much better, because they're not obviously as affected by interest rates as house prices are. The other thing that was quite noticeable in Ireland is the dichotomy between what's happening in the capital and what's happening elsewhere. So the CSO have a separate series. One is for Dublin and one is excluding the capital, which you can see here. And we also see that, again, Dublin has lagged in general the rest of the country. And it wasn't just, there's been a kind of narrative that, people are maybe want to work a bit more from home, so you're getting significant movement into, places like Kildare, Meath, Wicklow. They did see significant house price gains, but it wasn't just exclusively there. Very rapid house price gains in the border regions, for example, as well. But everything is now slowing. But in Dublin's case, the year-over-year change, as you can see, is just now 1.7%. But actually, house prices in Dublin have been falling for 6 months on the CSO index, down about 3% over that 6-month period. And elsewhere, they've fallen for 3 consecutive months, although not by that much. So you can see that we're seeing the same kind of pressures here, that house price, the cycle has turned over. So the question now is where does this cycle bottom out? And I'm going to look at the factors that I think drive housing, which I think are 5 or 6. And the first one is interest rates. And interest rates obviously affect housing in 2 ways. They affect demand for housing through mortgages, but also they affect the supply of housing through funding costs, and even availability of funding, which I'll come to. And if you look at this chart, what's interesting in Ireland is the fact that you've got the ECB rate here, the blue one, and that's risen by 375 basis points. So they only started raising rates in July last year. So here we are in June, 11 months later, and it's gone up from this is their deposit rate, which is the lowest rate they have, but that's affecting, largely determines money market rates. Went from minus 0.5, so it went to 3.25% in May. The interesting thing about new mortgage rates in Ireland is they didn't reflect that at all. And as you can see there, that's the average new mortgage rate, and you can see it's kind of around, kind of 275 for most of that period, which is kind of very unusual. So why didn't that? Why wasn't there an immediate pass-through? And the answer is, and I'll come back to this a few times in my presentation, because of the massive excess deposits in the banking system. Irish households have huge deposits in the banking sector, and that excess deposits meant that Irish banks didn't have to, or could absorb, the cost. So the cost of funding for the banks, if you like, is virtually zero, because the deposits pay virtually zero. Most of them, in fact, are current accounts or overnight deposits. So effectively zero. So banks the three remaining Irish bank lenders absorbed the ECB rate rise and didn't pass it on initially because they had this huge amount of deposits. Also, you can see though that it is beginning to start to rise. So we've had this was the figures for Ireland are only up to the end of March on this chart, which was 3.57%. Now, yesterday the ECB did produce the April figures, and the Irish one is actually just went up from 3.57 to 3.63. So the central bank usually waits about a week and then publishes that figure itself. So 3.63 is more or less around the Eurozone average. And so Ireland has gone from this strange this position here, where this was one of the highest in the Eurozone, to now around the Eurozone average, and all because of that, as I said, the deposit impact. The other thing about Ireland is a lot of media coverage, of course, the fact that there are people with tracker rates, which immediately respond to the higher refinancing rate from the ECB. But in Ireland, about 2/3 of mortgages with banks, and obviously some mortgages are with non-banks, but with banks, about 2/3 are fixed. So Ireland used to be a floating rate mortgage market. If you go back 10, 15 years, 95% of mortgages were floating. If you look now, 95% of new mortgages are fixed, and that's been going on for a good few years. So obviously the whole mortgage stock therefore moves to a much more fixed. The interesting thing though about monetary policy, because if you raise it, the whole point of raising interest rates is to get people to not to borrow as much and to spend less and bring inflation down. But if everything's fixed, then that doesn't have much of an impact initially. So where are interest rates going to go from here? And that's obviously going to be determined largely by this, which is the inflation figure. And so you can see clearly that inflation peaked back last autumn, basically. In the Eurozone, average inflation was peaked at just over 10%. And the main reason it is falling is because of base effects, because of energy. The thing about energy is that if oil prices go from 70 to 100 and just stay at 100, in a year's time the change is zero. So for base effects, inflation automatically falls. But obviously oil prices have gone from 95 or 100 back to 70. So energy prices are now negative year over year. And also, of course, there's been a massive fall in gas prices, and electricity prices should start to fall. Wholesale electricity prices have fallen very significantly. So the ECB, though, are concerned about that orange line, which is what that was called core inflation, which is excludes food, energy, alcohol and tobacco. And as you can see, the latest month does suggest that that might also have turned over, but it's not clear, well, I think it is pretty clear from the ECB that the majority of them are still worried about that orange line, if you like, and they're not happy to stop raising rates at this moment in time. But there are a few other things that I think are worrying, and one is the fact that there is a quarterly survey which doesn't usually get much attention. It's called the Bank Lending Survey, which is across the Eurozone, where they ask all the banks, including the Irish banks, questions about what are they seeing in terms of demand for their loans, but also about their credit standards. And what's quite noticeable in the last 6 months, there has been an extraordinary tightening of credit standards by banks across the Eurozone. In fact, unprecedented since 2008. So that does imply that you're going to see a very significant slowdown in lending across the Eurozone. You're already beginning to see that anyway, but this bank lending survey tends to be a good indicator of what's going to happen in the future. And I think they're worried about that, and that's why in the last meeting they went for 0.25%, because they had been raising rates initially by 75 basis points, then 50 basis points, now a quarter. So I think that's one of the arguments that may mean they'll slow down and eventually stop. Also, if we got some better headline figures, because I think the other thing that's quite noticeable, and it's not just from the ECB, some of you might have noticed about the Bank of England as well, that they've been much more upfront in saying that their models have completely failed to predict this inflation. Without going into a lot of detail, most models that central banks use assume the economy is in equilibrium. There's a shock, say higher oil prices, higher gas prices. There's a shock, and it moves back to equilibrium quite quickly. And that's what their whole models are based on. And that obviously hasn't happened this time. So they've lost a lot of faith in their forward forecasts, and that's quite obvious with the ECB. So I think the thing that makes me more concerned about a policy error meaning that you raise interest rates too much and you tip the economy into recession. And I think the problem is once you stop looking forward, because you don't think you can predict anything, you're just looking in the rearview mirror. Because this month's inflation is a month after it's actually happened. So if you stop looking forward, I think that raises the risk of these policy errors. But having said which, this is the actual ECB deposit rate, and this is what the market thinks it's going to be. Now, obviously, the market isn't right all the time. They're never right in some senses in interest rate futures, but at any moment in time, there's a snapshot of what the market is pricing in. So this is the ECB deposit rate at the end of each year, and you can see obviously we've gone from these minus figures. The end of 2022, it was 2%. Currently, I said it's 3.5%. So we're looking at another 3.25% it is currently. So the market is definitely priced for another quarter point rate rise, and then is giving a fair probability to a final quarter point rate rise. So if this is right, then we're not far off the peak. So the market is definitely saying another quarter point rise, and then possibly one more, depending on how the inflation numbers turn out. But as you can see, then that is the peak, and the market is then priced. It's not priced for a rate cut this year. America is priced for a rate cut this year, but in the Eurozone less so. And you can see that by the end of 24, we come from let's say 375 back to 275, and then the end of 25 back to 2.5. Now, if that is correct, we're not far off the top of the cycle. But also, of course, the other interesting thing is we're not going back here according to the market. In other words, they're saying that this period is an anomaly, and we'll go to lower interest rates, but 2.5%, which would have been the low in other cycles, rather than going back to negative. So as I said, that's where we're currently priced. That changes, obviously, with the economic data. what I would say is that the economic, in some ways, like the IMF, I always think is a bit of a contrary indicator, because they've gone more bullish on the economy in the last few months, revising up their forecast, whereas I think the hard data has got more negative. And for example, the German economy contracted sharply in the first quarter. Our economy, to come back to, also contracted. The funny thing is, Irish GDP is about 4% now of the Eurozone total. It's not that big, but if you multiply 4% by 4.5%, that has a meaningful impact on the Euro figures. So I think the Euro figures will be revised, and the Eurozone actually contracted in the first quarter, marginally, but nonetheless contracted. And I think if you look at some of the other figures, the hard figures, it would suggest that maybe the inflation is really beginning to hit people's spending. The other thing is that what central banks struggle with is, it used to be said that monetary policy affects the economy with a long lag, a year, 18 months. So the problem is, if you've raised interest rates quite a lot, the full impact of that is not clear yet at all. So that goes back to my point that once you start losing faith in what you're forecasting over the next year or 18 months, you do raise the risk of making errors. But nonetheless, as I said, the market is saying we are approaching. So the second thing that drives housing, and in my view, housing is largely, interest rates matter, of course, but in my view, to get a big housing fall, you either need banks to be in bad shape, or in case 15 years ago went bust, or massive rise in unemployment. Because if household incomes are growing strongly, that drives housing demand. And people talk about population, but there's lots of people in parts of Africa, but house prices aren't going up very much. You need to have the income to either rent or to get a mortgage. So household real incomes are a key factor. Now, real income's made up of, the change is made up of two things. People in employment get a pay rise, or somebody gets a job. So it's the product of employment growth and wage growth. So in our case, you can see here, this is the annual change in disposable income. And this is so it's the nominal is the blue, and the orange is the real income. In other words, you're taking off inflation. And as you can see, obviously, they move very closely together, very positive, very strong, for a long period, because by implication, inflation there is very low or non-existent. So Ireland had a very long period of virtually no inflation, and didn't make the news very much, but did it? You can see there that if your real incomes are growing at 5% per annum, that's going to be a massive stimulus for housing demand. Whether that demand goes into rents or mortgages, in part depends on interest rates, but also, as we'll see, on central bank policy and banks' attitude to credit. So you can also see that something odd has happened in 2022, and that is that obviously inflation has gone up quite sharply. It averaged over 7% last year. But what's interesting is that real incomes didn't fall. So that might surprise people, because if I'm working and I got so the average pay rise last year was about 3.5%. So if I got 3.5% pay rise and inflation was over 7%, my real income has dropped. But in aggregate, household incomes depend on the change in employment, and employment went up by over 5%. So consequently, household incomes went up by 9% and therefore real incomes actually went up. And I think this is the thing that I would always look at for warning signals about housing, and that is the labour market. And the blue line there is total employment in Ireland, and the last figure we got for the first quarter, still rising very, very strongly. It was up 102,000 year over year, 4.1%. It's quite quite an extraordinary achievement if you think about. I think it's almost like it's taken for granted now, but from Ireland's history of mass unemployment to this kind of chart is quite extraordinary. You can see that employment did dip during the pandemic and the lockdowns, but recovered very strongly. And the unemployment rate is down to, when this is the first quarter figure, it's down to 4.1%. They do a monthly estimate, and the May figure was released last week, you may have seen it. It's an all-time low. Briefly, we got to 3.9% in 2000, and we've never had 3.8% unemployment rate. So, record low unemployment. We're at full employment, and labour is scarce. I'm sure people who run business trying to employ people would know that. Labour is scarce. Capital isn't scarce in Ireland. We probably had, if you go back through our history, we probably had not enough capital, a massive amount of labour, and now we have the reverse. We have a massive amount of capital, but we have labour being scarce. So that is the key driver of the housing demand. The fact that employment is rising very strongly for a long time now. Third thing that affects housing is credit, availability of credit. And here's a chart of mortgage approvals. So mortgage approvals are published monthly, and I've just taken the 12-month total. So you can see that it did dip down during the COVID again, but recovered. So they're kind of rolling along at about 40,000 approvals a year at the moment. So as you can see there, right now, that there is no clear sign that that is dipping down. I did mention earlier that this bank lending survey did show that Irish banks had tightened standards very significantly. In fact, again, the most significantly since 2008. So that may presage a fall in approvals, and therefore a fall in lending. And as we'll see, house building probably will be lower this year as well. So I think that's worth keeping an eye on. That when I say tightening credit standards, what does that mean? It means that banks will ask for maybe higher deposit or at the margin turn people down with a certain level of income if they think maybe that the job that they're in is more likely to be affected by a downturn in the economy. So that may affect that as we go forward. Also, just as an aside, the actual mortgage lending figures are published quarterly on a gross basis. But what the headline often mentions, the gross total. But in the last 18 months, particularly, mortgage lending is made up of people borrowing money to buy a house, which is what matters, but also people switching. But if you think about switching, if I have a mortgage with Ulster Bank and switched it to AIB, that is counted now as an AIB mortgage, but the net impact is obviously zero. So it's artificially inflating the actual lending. I think this is the thing that possibly doesn't get enough attention in Ireland, the fact that for some time now, credit growth has been negative. And actually, when you look at the central bank, they do a monthly update on money supply, credit. They've emphasized for some time now consumer household deposits. And they very rarely mention credit anymore because credit is actually contracting. So this is the net mortgage lending year over year. So why is it contracting? So new mortgage lending is obviously growing, but it's being offset by repayments. So if you think about Irish mortgage lending, when was it, it really took off in the noughties. So people who took out maybe 20-year mortgages at that time, they're now obviously all being due to repayment. So net mortgage lending is negative. And remember last autumn, the central bank, kind of surprisingly, I thought, given the cycle, eased the mortgage rules. If you remember, first-time buyers could get a mortgage 3.5 times your income, with exceptions. They increased that to 4. Now you might think, if interest rates are going up, why would they do that at that moment in time? And they kind of vaguely said, oh, it was because they thought it was affecting the supply of housing. But I mean, that was obvious 5 years earlier when they brought it in. So I think this was really the reason that they were concerned about the contraction in credit growth. This is mortgage credit growth, but overall household credit growth was negative. Fourth thing that affects housing is supply, and here is the annual. The figures are published every quarter, so this is just taking the 4-quarter figures, and you can see that there has been a very significant increase in housing supply. We've gone from 10,000, only 5 or 6 years ago, to around 30,000 currently. Obviously, it was affected by the pandemic and the shutdown and the lockdowns. So 30,000 a year. I suppose most analysts think that we need significantly more than that. I think that's pretty clear. How many houses do we actually need? Some people think 35,000 a year. People think even 45,000 a year. But of course, even if it was 35,000 a year, each year you've got a massive shortfall. So you're building up this big excess demand. The supply is changing a lot. The government obviously is concerned about getting the numbers up for political reasons as well. So there's much more emphasis, I think, in pushing developments towards apartments. So apartments are now about 1/3 of completions. So that's quite a change in the Irish housing stock historically. Apartments would have been relatively low, and obviously it's increasing significantly. So where are we going from here? And there are two kind of things I suppose analysts look at in terms of housing supply going forward, and to be honest, neither of them are very good predictors, particularly very accurate. But anyway, one is if you look at planning permissions. Now, in a way, a kind of planning permission is a necessary condition to build a house, but it's not a sufficient condition. In other words, you can have planning permission and it's never built. But nonetheless, you can see that planning permissions did increase significantly, but they have actually started to tail off on an annual basis lately. And the other one is a monthly figure which is produced by Department environment, which is commencements. And again, it's not. You'd think it'd be more accurate than it is, but nonetheless, that does suggest as well that we are going to see maybe a slower increase in housing supply over the next year or so. As we all, I'm sure a lot of you know better than I, the difficulty of building houses in Ireland, the cost, the complexity, the delays, planning, and so forth. But obviously, costs have risen, raw material costs have risen significantly. House price growth itself is a driver of supply. And one of the odd things I think about when you look at people's forecasts for housing supply, it goes up forever. But obviously, if I'm a developer and I think house prices are rising 15%, I'd be more inclined to build a house than if I think it's going to fall 5%. So house prices itself help determine supply. So if house price inflation slows, supply will slow. And obviously the problem always with supply is that there's a big time lag between actually starting building and you selling the house. The other thing I find odd is the fact that, as I've said a few times through the presentation, we're at full employment. Labour is scarce. So how people can stand up and say we're going to build 50,000 houses in the next few years, but where's the labour to build the 50,000 houses? And one of the issues for Ireland is, of course, we've attracted massive immigration into the labour force, but a lot of people that were coming from other parts of the EU, for example, like Poland, it's more expensive to come here, to live here, and find a place to live yourself, and B, a lot of those economies, particularly Poland, is booming itself. So the attractiveness of Ireland as a place for EU labour has diminished. Next thing that affects house prices is expectations. So expectations in terms of price, in terms of my income, is going to affect on the buyer side. If people think house prices are going to rise very sharply, they'll bring forward the decision to buy. And conversely, if everyone thinks there's going to be a recession and house prices are going to fall, they may postpone that decision. And similarly on the supply side, from the builder side. So this is a thing the Society Chartered Surveyors of Ireland do every year. They just do a survey of a lot of professionals in the business and ask them where do our price is going to go up or down over the next 12 months. And it does tend to be very volatile. So during the pandemic, people did think house prices are going to fall sharply the following year. I suppose at the margin they did marginally fall, but then they thought they'd recover, and now they still think that they're going to rise in 2023, but not a huge majority think that. The actual average expectation is around 2%. But at the moment, nobody thinks there's going to be a 10-15% fall. Next thing that affects housing is policy issues. Now, I'm sure as everyone's aware, that housing is obviously a huge political issue for the government, and I always find it odd that the government has housing targets, because obviously the government doesn't build houses at all for a start. Most houses are built by the private sector, so having a target that you can't actually directly influence seems a bit odd, but anyway, nonetheless they do. But obviously on a policy perspective from the government side, what they're doing is obviously boosting demand and negatively impacting supply. So if you bring in rent controls, virtually any economic study across the globe tends to show that if you control, push the price, keep the price of rent below a market rate, you'll dampen supply. That seems pretty clear. But obviously, the government pressured into making populist choices like that, but it's not going to boost housing supply. And on the demand side, of course, you're significantly boosting demand via, first of all, the Help to Buy scheme, so you can get 30,000 back from your tax paid over the last 4 years for your deposit. So the central bank brings in loan to deposit limits, and the government brings in a scheme to more or less get around that. But the biggest influence, I think, is the central bank itself and its loan to income measures, which were brought in 2015, and with very little consultation, just brought them in. I think I was looking recently and was interested that in Britain, the loan to income limit is 4.5, and it was brought in around 2012, I think. But the authorities there, the Bank of England, was saying that it needs a good bit of debate, because mortgages, the central bank tends to think of them as a credit thing, obviously, which they are. But housing has a massive influence on wealth. So Irish household wealth is now above 1,000 billion. And most of that is housing. So an awful lot of people have housing with mortgages. They've either paid off the mortgage, or the equity in the house is significantly more than the mortgage. And that is the main reason why people get wealthy, is through housing, their own house. And therefore, if you bring in a scheme which dampens leverage, yes, you're going to influence, you're trying to stop people borrowing too much, you're trying to stop people banks lending too much, as it were, but you're also going to have a massive social impact and a generational impact, which doesn't really get discussed when they brought it in. But anyway, if you look here, this is the loan to income, and you can see that if you go back to before the crash there, the average loan to income was about 4.5 at the peak, but the 90 percentile was nearly 6. I would say, by the way, these figures weren't available at the time. The amount of information that we now have from the central bank, all banks have if you follow banks, you look at some of their reports, the amount of information they give is dramatically different from what it was 10, 15 years ago. But nonetheless, you can see that there's been a significant change, and the central bank in 2015 brought in the loan to income limits. So you're dampening down leverage. So you say, okay, then that'll avoid a credit boom. Well, clearly we haven't had a credit boom, it's contracting. But also, as I said, what it will mean is that you will probably, well, the central bank's own research shows, if you bring in those limits, you'll dampen down credit creation. You'll dampen down house price inflation, but you'll also dampen down supply of housing. So the argument they put forward in changing them recently to 4 was on the supply of housing. But the other thing that you're going to do, of course, is if there's a significant increase in the demand for housing, how much will go into rent and how much will go into mortgages? Partly will be strongly affected by these limits. So if you dampen down leverage, you're going to dampen down the number of people who would be buying, and therefore you're increasing the number of people who are renting. Just say one more thing about that. I haven't got a chart of this, but one of the unusual things about the Irish housing market in this cycle is that the foreign participation. in the previous cycle in the noughties, there was virtually no foreign participation, other than foreign-based banks involved in lending through the Irish market. But in this case, there's been two significant differences. One is on the demand side. So if you have zero interest rates and a 10-year government bond gives you a negative yield, then that pushes a lot of financial institutions into the property market in a way they weren't there in the previous cycle, because bond yields weren't negative. So if you can get 4 or 5% as a financial institution by buying, building, and then renting out property, that's been a big factor this cycle, which didn't exist in previous cycles. The other thing that's been a big factor in terms of foreign participation is on the funding side. So this chart shows you bank credit outstanding for property development. So if you look at that chart, you can see pretty clearly that Irish banks have not been funding to any great degree the property cycle this time round. Now, they might argue, well, first of all, when we make a loan, it's risk weighted, so you have to put a certain amount of capital aside. The risk weighting is largely a legacy feature of what happened to loans in the past. So mortgages have a high, the average risk weighting in Irish mortgages, I think, is currently about 35%, whereas the average risk weighting in the UK is about 10%. So that has a big impact on the cost and availability of credit, but also in terms of particularly commercial lending and residential lending. So because of the sins of the past, if you like, banks have not really funded a lot of the development we've seen, both commercial or residential. So who is funding it? And the answer is a lot of non-banks. And those non-banks include foreign investors, again, who look into a market, see the residential yield, and are prepared to take that risk in an environment where the alternative, the risk-free rate, is 0 or even negative. Now, obviously, that has changed. So, if you can get 3%, 3.5% or more on a 10-year government bond, depending on which country you're in, then obviously that changes the dynamic. And we see that quite clearly in, for example, in commercial property, which has slowed down much more sharply than residential. But one of the striking things about Ireland, and has a huge impact on the banking system, is this. The extraordinary change in household behaviour in the past 15 years. That in 2008, Irish households' debt was about over 200% of their disposable income. So most of that was borrowing for property. That figure is now 93%. So over the last 15 years, Irish households have been deleveraging, in the jargon of economics, at an extraordinarily relentless pace. Yes, there's been some new lending, not that much, but that's been more than offset by this relentless debt repayment. A lot of households not wanting to take on debt, a lot of households running down their debt. And on the flip side, so that orange line is the actual amount of debt. It was over 200 billion, and it's now down to about 135 billion. So it's 93% of disposable income. On the other side, a massive increase in liquidity. So this is household cash in deposits, it should be actually. And you can see that's relentlessly moving higher, and particularly pandemic and post-pandemic, it's still rising very strongly. So we have this situation. We went from there, where households had massive debt, well above any deposits the household had. Now these are aggregate figures, of course, so obviously some households don't have any deposits at all and have a lot of debt. And some households have a huge amount of deposits and no debt, but you know, these are the aggregate figures. And you can see now that the total cash and deposits is approaching 200 billion, and massively in excess, 63 billion in fact, in excess of the debt the households have. The flip side of that is had a massive effect on the banking sector, because a lot of deposits are in current accounts or overnight. If you think about what happened, for example, during the pandemic, if you were in a professional job, public sector or professional job, you kept your job. So you're getting paid let's say every month, salary goes into your current account. Suddenly, for a good period of time, you couldn't spend on a lot of, you could buy goods, but you couldn't spend on a lot of services. So consequently, the amount of cash in your current account, if you like, forced saving, went up very sharply. So consequently, the amount of household deposits in the banking system is enormous. So this chart shows you that household deposits, this is the total deposits in the banking system and total Irish bank loans. So these are the three Irish banks and remaining lenders. And you can see that there's a huge excess deposits. And that is why, when the ECB started raising rates, that the Irish banks didn't immediately raise the new mortgage rate, because they had this huge excess of deposits, still have. So the other reason I think is that if you look at the mortgage market over the last 3 or 4 years, what happened in 2021-22 was that non-banks, of which there's maybe 3 main lenders, they started to increase their market share. And the reason they were doing that is because they don't have deposits, so they were funding in the market, but they could fund at fixed rates in the market at very cheap levels. That has changed, but also the Irish banks have this now competitive advantage, and they are using that to regain market share from the non-banks. And that's another reason why they didn't push rates up. But obviously there's a good bit of media attention now on the flip side, which is that why, if ECB rates have gone up so much, why is my deposit rate not gone up at all? So there's a bit more pressure on them to do something about deposit rates, but really they don't have to, because they've got so much sticky deposits. These deposits are very sticky. So massive excess liquidity. And obviously, what will happen in this environment, it's very profitable for the banking sector. Not only, one of the problems with the banks, if you go back over when they had negative interest rates, is the tracker problem, which is twofold, of course, but the actual cost of the tracker for them. The average tracker spread in Ireland is about 1%. So if the repo rate was 0, a lot of people had mortgage rates of only 1%. Now, obviously, with the refinancing rate is 3.75%. So a lot of tracker rates are 4.75%. So that's been a huge impact on them. So that's a massive profitability boost to the banks in general. Also say that there's a lot of emphasis in the media about the budget. and tax cuts and all. But if you think about an average budget, the amount that the government can actually cut taxes by is tiny. It doesn't have a huge effect on anything really much. But if you think about tracker rates, in 2012, 13, the average cost of a new mortgage was about $1,600 a month. And say 2 years ago, the average cost was like $850 a month. And people on tracker rates had a massive stimulus, way in excess anything that would ever be delivered by the government. The final thing about the banking sector is the fact that, and the reason I'm emphasising this is because, to go back to one of the points that I was making, that for housing to have a real downturn, you either need a significant rise in unemployment, which we don't see at the moment, or you need the banking sector to be in serious trouble. Now, I'm suggesting that we probably will see a bit of a credit, not credit crunch, but maybe tightening of credit. But the profitability is very, very strong. And if you follow the share price, you'll see, you go back 18 months, Irish banks were trading at like 30% of the net asset value. Not just Irish banks, European banks. They've had a massive recovery. This is something which doesn't get enough attention either, and that is they're getting a massive amount of money now from the central bank. And the reason for that is that there's so much, the ECB created a massive amount of excess liquidity. Banks have to hold a certain amount of reserves with the central bank, and that is determined by it's basically 1% of their deposit base, roughly. There's variations, but roughly that. So it's a relatively small sum of money. But the ECB, in trying to get inflation, which is an irony now, trying to get inflation up, has pumped massive amount of excess liquidity into the system. In fact, at the peak was 4.5 trillion excess liquidity in the Eurozone money markets. So what they were doing is they were buying government bonds and crediting banks, creating deposits for banks to pay for it, and also lending banks a lot of long-term money at very favourable rates. So the upshot is that on the blue line is the amount of excess deposits in virtually all excess deposits from Irish banks with the Central Bank of Ireland here. And you can see it's roughly 90 billion was the last figure. So that's on deposit with the Central Bank of Ireland. So what rate does Central Bank of Ireland pay on those deposits? And the answer is the ECB deposit rate. So that's gone from that. In other words, it was costing the Irish banks money to leave it with the central bank, costing them 0.5% a year. But they're now earning, and this only goes up to March, 3%, it's gone up to 3.25%. So if you multiply 3% by 90 billion, that's 2.7 billion. So that's how much the central bank is paying to the banking sector. So what does that mean for the Central Bank of Ireland? That's great for the Irish banks, but what does it mean for the Central Bank of Ireland? And in fact, they're going to make losses. And the reason they're going to make losses is because they made a huge amount of money for the past 10 years for two reasons. One is, some of you may be familiar, remember the Anglo bonds, as they were called, that were the central bank bought, and they've sold them over the years at a massive profit. And over the last 10 years, the Irish Central Bank has paid 20 billion to the Exchequer. very rarely mentioned in the budget. It's there, but they don't emphasise it. But 20 billion was paid by the central bank, and that's not all. It tends to keep about 20% of its profits as a reserve. But the second reason is the central bank was buying a lot of Irish government bonds. They own about 65 billion of Irish government bonds. There's 140 odd billion Irish government bonds out there. The central bank owns 65 billion. So the interest that's paid on the bonds goes to the central bank, and the central bank pays it back to the exchequer. That was QE. So the problem now for the central bank is they've sold, I think they've only got 500,000 of the Anglo bonds left. So they've all gone. And the secondly is all of the bonds they bought, their interest, the coupon on the bonds is like 0.5%, 0.25%, possibly even negative in some cases. So they've publicly said this, they're going to make losses over the next few years. So again, it's a massive transfer to the banking system. Now the losses will obviously be paid out of, there's a lot of reserves over the years they've built up. So to conclude, I think the key thing in Ireland is we've had very strong employment growth, and that is still continuing. I know we got a strange figure the other day, the economy contracted sharply. That was more to do with hopefully a quarterly oddity in some of the multinationals. One of the things that maybe people don't, not given enough attention is from 2015 onwards, exports are counted differently. Exports used to be, you make something here and you sell it abroad, that's an export, which is still the case. But what they also add in is if the ownership changes. So in our case, we have, and it's I think mainly Apple. Apple has an operation here, but outsources the making, let's say it's the iPhone, to China. That production is classed as an Irish export. If you remember 2015, the leprechaun economics and all that kind of stuff, that started then and had a big impact that year. So as far as I can make out from the figures, one of the reasons GDP was negative was that offshore, it's called contract manufacturing, that fell. So it may be just an Apple thing to do with what was happening in China at the time. But anyway, as long as that is just a one-off, our GDP continued to grow. But what matters is the underlying economy's consumer spending is quite strong. Construction has been fairly good. So a lot of employment created in the service sector as well. A lot of issues, a lot of talk about our tax thing. To my mind, there's quite a noticeable underlying change in the Irish government, not making explicit what I think is going on. There were two proposals for global tax changes, Pillar 1 and Pillar 2. Pillar 2 is going to come in Europe. The minimum tax rate goes from 12.5% to 15%, and the Irish finance minister said he'd probably bring it in for next year. That will increase Irish tax receipts. I never understood how that would reduce them. And if there is a global minimum, why would anyone leave to go where they're going to go? So I thought that argument was bonkers. But the second argument was actually more serious, and that is the Pillar 1 takes 20% of profits that made by, say, Apple in Ireland, and allocates them in terms of where Apple has sold its iPhone, sold its products. So that is potentially more serious. But that Pillar 1 has run into some would say, run into the sand. America will never pass that anyway, so it's a bit unclear what's going to happen to that. If that comes in, it'll be negative for Irish tax receipts. If it never comes in, will be a net positive because of the higher tax rate. And the fact that the Irish government is now projecting these large surpluses for the next 4 years would suggest to me that they kind of think this isn't going to happen now. That the pillar won't. So, as I said, as long as and I think the big issue for corporates coming here, oddly enough, is housing. We see it quite often now that a lot of companies are saying it's difficult to house their workers. So if FDI starts to drop off, it's to do with housing rather than tax. As I said, the supply is the key factor in our market. It's obviously lagged demand very significantly for a long time, and probably dampened down a little this year. But as long as, suppose, as underlying demand stays strong, that's unlikely to go from 30,000 back to 20 and stay at 20 or fall. It's more likely to start back up again. I think the big factor will be expectations and when rates are clearly seen to have peaked. Then I think you'll see expectations change again in the market and demand start to pick up again. Also, in theory, of course, banks can lend a bit more when the cycle turns because the LTI is not going to. And so I think the bottom line is that if you think about house prices in real terms, they're actually falling. So if you have 7% inflation and house prices go up by less than that, then in real terms they're falling. In nominal terms, I think by the end of the year they'll be maybe up 1 or 2%. So they'll fall in real terms, but not in nominal terms. But I can't see a huge, what's that, 5-10% fall unless we get a big shock to employment, and or the ECB says, okay, we haven't killed inflation yet, and we start, instead of going to 375, we go to 450 or 5%. Then I think you're in a different ballgame. So I think overall, we're likely, to my mind, that's the most likely scenario. Some kind of a slowdown in supply, underlying demand still fairly strong, but affected by the rise in rates. And as I said, unless we get this employment shock, and if interest rates have peaked, we should see kind of flatlining rather than massive fall in house prices.
Thanks, Dan.